tomorrow.
This has become the EdTech Natasha show, but that's actually okay because it's one of the most interesting sectors in the world. But from the most interesting into the least, we have to go straight from that right into SPACs. We have two short SPAC stories that Danny's going to talk us through because they actually matter. Sorry to go back into the esoteric of the finance world, but this is big news. So Danny, Opendoor, what's up?
Yes, so if schools are closing their doors, Opendoor had a much better week this week. So Chamath has started his second SPAC a couple of months ago. He was seeking out a deal, and we learned this week that he is buying out Opendoor, which is a company that's designed to basically buy and sell homes extremely rapidly. So they're the Amazon of home sales. So instead of spending months trying to sell your home, the idea is you click a button, type in your address, hit a checkbox, and theoretically you've sold your home instantaneously. And so what we learned this week is that Chamath has valued the company with an enterprise value of $4.8 billion. That is up from a $3.5 billion pre-money valuation just a couple of months ago last year. And, it's actually, I think, one of the most blockbuster SPACs we've seen so far in terms of an acquisition.
I think it's the biggest one by far. I didn't think we were going to see something this big this quickly, but apparently the SPAC game is further afoot than I would have guessed. The actual enterprise value, Danny, is cash, market cap minus cash, right? So it's actually a $6 billion total worth minus, 4.8. I got it. But it's not the only SPAC out there raising money. There's been another one, a company we've talked about based in Boston, I believe. Desktop Metal is going public via SPAC. What's up with that?
Yeah, we learned about this 2 weeks ago, but what we got this last week was Desktop Metal and its SPAC acquirer actually filed the S4 paperwork. So if you're familiar with the S1, which is for IPOs, when SPACs combine with a company, they have to file an S4. As part of the reverse merger sort of going public process. And so we learned a lot of details about the investors behind Desktop Metal. So Kleiner Perkins, which invested earlier in the company and did not invest so much in the later stage rounds, had about an 11x return on its investment in the company, along with Lux, NEA, and a bunch of others making huge amounts of money on the deal so far.
So here's my question about these two SPACs, because when I think about SPACs, I think about the funding of last resort. And I was just talking to Maha Ibrahim from Canaan about this on a panel this morning. These are companies that were fine. You know, I've heard of Opendoor. I've heard of Desktop Metal. Why are they not going public in a more traditional manner, Danny? Is there an advantage to these two SPACs that we understand, or is there something behind the scenes more that's driving this sort of operation?
I think like any of these processes, you're going to see a range from very strong, like we're going to talk about Snowflake, which is obviously a very, very strong company, to weak. The SPACs are no different on that front. When you look at Opendoor, Opendoor had a sort of a weird 2019, right? It actually grew its top line revenues very highly, but profitability and margins went way down. In 2020, obviously, with coronavirus, the real estate industry collapsed in March, April. It's now zoomed back in June and July this year, were some of the strongest months for same existing home construction sales in the United States in history. So, when you have those complicated stories, I think SPACs are a nice opportunity to say, hey, all we have to do is convince one acquirer to buy us out who believes in the story. So Chamath believes in Opendoor, much as the SPAC that's buying Desktop Metal believes in the future of metal 3D printing. And you don't have to go on that roadshow and try to convince, hundreds of bankers and on the buy side on Wall Street that this actually exists as a market.
Let me add too, from the last time I spoke to Chamath, asked him a little bit about his double or dual pronged strategy towards becoming the next Berkshire Hathaway, as he says again and again. And, he definitely said SPACs will be one way. Another way will be acquiring majority stakes in companies. So we saw him scooping up Hustle, which is peer-to-peer texting, and then a mental health therapy startup. And so I'm starting to now put together these pieces of like Chamath's new ecosystem. He's imagining down the road SPAC returns will fuel majority stake acquisitions. And so it's starting to color in more for me, this strategy of his. It's not unique, but it's interesting.
The Berkshire Hathaway comparison, given what we all know about Warren Buffett and Charlie Munger and how they've gone about building value, is going to be so interesting because Chamath is going to be paying a lot of money for unprofitable shares versus those two guys famously bought value stocks and then held forever. Like Warren Buffett's Coca-Cola bet's a famous example of this. So I get the idea of wanting to kind of ape the structure of Berkshire Hathaway, but certainly a different kind of investment thesis going into it. And so we're going to be able to compare the returns and see, because we have, Berkshire Hathaway returns forever. We can kind of stack them up and see how they do. So I hope Chamath does well, because it'd be fun to have another Warren Buffett, because we won't get to keep the original forever, but skeptical. I think
And I think, ownership is just a huge topic of the Valley right now. One of the sort of sub stories with Desktop Metal, obviously a great return for all the investors involved, huge, nice uptick, but like no one really owned this company. So NEA was the largest investor with owning just slightly less than 18%.
Yep.
Lux had 11.5%, Kleiner 11%, GV 8%, Northern Trust 7%. Like when you own only a couple of points in a company, even in an exit like this, where, you're talking about a multi-billion-dollar exit, even multi-billion times 0.1 times 0.08, just doesn't read to a real return. And so, I think we're going to see more bets where people do take majority stakes, do try to take, 30, 40%, because there's just so much more upside. You have much more control of your own return profile than when you only own a tiny little chunk.